employed people, for example, has gone from more than 2 to 1 to now 1.3 to 1, and it was 1.2 before. So that's a decline in demand. That's demand related. You also see wages coming down. You see quits coming down. So I think that tells you that policy is probably restrictive. I think it's also fair to say, though, that the U.S. economy is different this time for a couple reasons. One is that people financed themselves into very low-rate mortgages, and now they won't move because they would be moving into a higher-rate mortgage if they did, and they would be throwing a lot of value away. The same is true of businesses, many of which, this time is different, have termed out their debt, and so they're not feeling the effects of interest rates. So it may be that policy is hitting the economy not quite as strongly as it would have if those two things were not the case. Notwithstanding that, I think the overall picture still is policy is working. It's weighing on spending. It's weighing on interest-sensitive spending, and it's certainly weighing on the labor market. It's a question of restrictive policy. As I mentioned, our policy is the highest it's been in quite some time. The rate is, at 5.25% to 5.5% is high relative to recent history. So we think that it's probably a matter of just staying at that stance for longer, and that's how we're thinking about it.
And I mean, you note about housing and about the standard model in the US being I think around the 30-year mortgage is kind of the standard mortgage product. I think here in the Netherlands, flexible rates are quite more fixed rates.
Yes, absolutely.
So fixed rates are quite common too, but I imagine with shorter
10, 16,
duration.
An average mortgage, I think, has an average maturity of like 16 years. Of course, that's a little bit endogenous because of the low interest rate period we had for so long. That, of course, mortgage holders tended to extend maturity. So now, lately it's been coming in a little bit, but still we have a lot of fixed rate borrowing in the Netherlands, and that has, of course, also mitigated the impact of the monetary tightening, which has been stronger in those areas where there is more variable rate borrowing. But in general, I would say 85% of all financial intermediation in the euro area runs through the banks. So when you look at monetary transmission in the euro area, you have to look at credit. And credit growth has more or less come to a halt. As a consequence, we increased policy rates by 4.5% within 14 months. Credit growth came to a halt. That was a feature of the policy, not a bug. And credit has been flat.
Feature, not a bug.
Well, and now we're also beginning to see the first signs of life again. Now, that there is an anticipation that our next interest rate move will be a reduction of rates. You also see the first signs of recovery in credit. So in that sense, I think this is more or less how you would expect monetary transmission to take place in the euro area.
And how much of an issue has that been for you in the US, where we do have this, where capital markets play a far greater role, and where, for reasons that were never quite clear to myself, the turn of the year, the markets were predicting, 6 interest rate cuts by the Fed, and pricing credit off the back of that, and there being quite a big, quite substantial growth in lending and refinancing over the first couple of months of the year. How much more difficult does that really make your task that the banks aren't as big a vehicle?
For what it's worth, it's a minority of intervention, but banks are still important, and particularly for small and medium-sized businesses that don't have capital market access. And credit has been tighter for some time now, particularly in the wake of the turmoil we saw earlier last year. But still, credit growth has been modest, and that's another sign of tight financial policy. So that's part of the picture. I think the fact that we have capital markets are so important for many consumer loans of various kinds wind up in the capital markets, are securitized and are not held by banks. It's just that it's a very healthy credit machine for people, but they're feeling these higher. Those are short-term interest rates. I think the ones that are longer-term interest rates are the ones where they're not feeling it, and that's really mortgages, and that's companies that have turned out their debt. I think other forms of consumer debt are short-term, and the surveys show that people think it's not a good time to buy, durable goods like cars and washing machines. And the reason is it's a floating rate loan at a very high level.
Absolutely. And when you look at the banking system as a whole, we've seen some jitters, I think, on both sides of the Atlantic. But on the whole, it seems both systems are relatively stable, despite quite substantial rises in interest rates. Has that surprised you at all? Maybe first to Chair Powell and then to President Knott.
Has it surprised? Not really. Our banks are particularly our large banks are, strong, well capitalized.
They're on the banking segment now, which is a little on the boring side. I think once he gets off the stage, you kind of clear for a bullish catalyst, but we'll see.
Why the recovery broadly around the world from the pandemic has been strong as opposed to the one from the global financial crisis is that the very large financial institutions came through just fine. The U.S. banking system overall is in good shape. Banks are making loans, as I mentioned. Credit conditions are a bit tight, but that's part of our policy. So I wouldn't say I'm surprised. I think we obviously had a period of turmoil early last year, and we acted pretty quickly to stem the turmoil and also to go to work as a supervisor and make sure that banks had good plans on liquidity, had capital, understood the portfolio losses that they have for longer run securities, and are in a position to understand and manage those.
Well, I think it's pretty clear that if you have such an unprecedented rise in interest rates in such a short period of time, that this constitutes a massive shock to the financial system. So when we were sort of in the process of tightening, of course, this was sort of enhanced monitoring, an area for enhanced monitoring. Now, I think we can say so far so good. I entirely agree with Chair Powell that the core of the financial system has held up quite well. And I think this is in part, I think the success of the financial reform agenda that was rolled out after the global financial crisis, or the ages of the Financial Stability Board, which was very much focused about stronger capital, stronger liquidity, stronger risk management at the banks, which were at the core of the financial system, and that has clearly paid off. Now, there have been some idiosyncratic accidents here, the second-tier U.S. banking system, Credit Suisse, but I think there were idiosyncratic factors behind it. The banks that arrived into trouble in the U.S. were not even part of the Basel III arrangement and the financial reform agenda. But I would say so far so good. The question marks today are much more in the non-bank financial intermediation space, where we have seen a couple of quasi-near-miss accidents, I would say. The Dash for Cash, the LDI, the Archegos, the commodity traders in February 22. So these have all been pockets of vulnerabilities where you saw a combination of excessive liquidity mismatches combined with pockets of hidden leverage that we were unaware of before. And that is now also front and center of the work program of the Financial Stability Board, much more in the NBFI space. Of course, we have to learn the lessons from the few banking failures that we did see, and that is continuous.
Oh yeah, just a few banking failures, don't mind them.
My main focus is more on the NBFI space than on the banking space.
We'll come back to Credit Suisse because I know that's a topic that you've spoken about quite a bit, and a few of our audience have got questions on that. But non-banks, would you share that, that sense in which they're the big lurking danger in the financial system right now?
I guess I would say it this way. In the U.S., non-bank participants by non-banks in lending activities, for example, has been growing very, very fast. And it's a fairly new thing. And in many cases, whole markets are being now taken over, or now majority for non-banks. And so our job is to monitor that very carefully, because I'll say a couple of things. One, there hasn't been a downturn yet. You worry about very fast growth in anything. It just kind of raises financial stability questions, and you wonder, is it a bubble? What will happen? Will it deflate? And that kind of thing. And so you want to be watching it carefully. I will say though, it's different. Some of the we've spent a lot of time looking at it. I would just point to a couple things. One is many of the lending structures are not subject to run in the way that banks have traditionally been. The funding tends to be from limited partners who have their investment locked up for many years, and they can't get it out. So as opposed to the danger with a bank can be that all the depositors want their money at the same time, and that's the traditional problem that we've been trying to solve with bank regulation for hundreds of years. But these are different. They don't have, and runs are responsible. Bank runs or things like that are really responsible for an awful lot of the problems that happen in one form or another. So the non-bank financial sector doesn't have that as much. Another thing is the ties between banks and the non-bank financial institutions are substantial and growing. So there's plenty of monitoring for us to do there. It's not obvious to me that at this point that it's a net loss to financial stability, but I would say our jobs are to monitor it very carefully and thoughtfully and understand the implications.
Just to return to the topic of Credit Suisse, with a question submitted ahead of the event, in your keynote speech at the 7th Annual Conference on European Systemic Risk, you talked about events surrounding Credit Suisse. What could the Foreign Bankers Association, to which we're speaking today, and the Netherlands Bank learn about the collapse of the Swiss lender?
Well, I guess the main thing one can learn about the collapse of Credit Suisse is the huge importance of governance within financial institutions, because it is pretty clear that the events that led to the failure of Credit Suisse were not sort of a classic lack of capital or, let's say, too much credit risk relative to the capital. It was management failures, there was outright fraud, there were misinvestments, there was misbehavior, even at the top of the institution. And if you have a series of governance failures at an institution, it will lead to an erosion of confidence. That erosion of confidence will lead to deposit runs, which, by the way, already took place much earlier than March 23. There was already a significant outflow.
Quick note, I'm pretty bullish on J-Pow getting the hell off the stage, because so far everything he said pretty bullish. I think there's a chance we rally into the close. If you're in the Stocks and Psychology of Money group, I sent out an alert on some trades we're doing. If you're not in that yet, join. Coupon code expires tomorrow. Email us at staff@meetkevin.com if you have questions.
Yeah, of course, there was a case where AT1s have been completely written down. So I think it behooves us to look a little bit deeper into this issue. Why the AT1s were drawn down, whereas equity was not fully written off. This was, by the way, completely in line with the contractual provisions of the AT1. It was just not all investors have really read the contractual provisions, so they pretended they were surprised by it. But I think from every case, I think we should try to draw some lessons. But in this case, at least, it allowed the authorities to write down 60 billion Swiss francs, which was helpful to generate the interest of UBS to actually take over.
And now turning back to you, J-Pow, we've got a very nice question here from Liu-Zhan from ICBC, who asks, during COVID, the Federal Reserve applied high levels of military stimulus to further raise asset prices and support growth. Bloomberg called you Wall Street's head of state as a reflection of how strong your actions were on asset prices and how profitable your actions were for Wall Street. How does that make you feel?
Don't ruin this, J-Pow. I want the green to continue.
In hindsight.
It makes no point of contact with the way I remember those days, so whatsoever. So I would just say this. If you put yourself in the place where we were in March of 2020, no one knew how long it would take to have vaccines. No one knew whether millions of people were going to die fairly quickly, and or how long the economy would remain closed, or was it even going to be possible to reopen the economy if it had to be closed for a year? What was that going to look like? So it was so uncertain that I came to the view, my colleagues did too, that we really needed to use our tools in ways that we hadn't before. Because I would never have been, if things didn't work out, I didn't want to, if we had to go through a really deep, lengthy downturn, I would not want to have to explain why we didn't do that. So we did, and what happened is we announced these very aggressive, vigorous programs to support markets that we had never had to support before, the municipal market, corporate debt, these were red lines that we said would never cross. But the thing is, when we made the announcements, the markets healed themselves. So we made very, very few loans. We had something like $6 trillion in lending capacity. So the announcement effects of the things that we did really worked this time. So I think, broadly speaking, that the initial response was very successful, and it involved ultimately very, very little in the way of actual lending, a lot of announcements. Then the story goes on, and you have the reopening and the inflation, and we're still living through that. I think we'll have to judge that from a greater distance.
Anything you do differently in retrospect?
There's nothing I would do differently in the initial response. I think we did very well, and I think that the world continues to benefit from the strong response that we took, and if we really avoid an awful lot of bad tail risk there that could well have come due. Again, I would say on inflation, when inflation kind of unexpectedly arose in the first quarter of 2021, I think we're going to need to, I've tried to resist reaching, conclusions about that episode until, it looks so different now than it looked a year ago, for example. All the progress we made in 2023, I think we're talking about it in a completely different way now. I think 2-3 years from now we'll be doing the same. So I don't want to try to learn lessons, kind of in the middle of the story.
That's very fair. And another question here that's just been submitted from Abia, who asks, is Chairman Powell confident about the degree of independence of the Federal Reserve in relation to the executive branch of government? Do you think you have the powers that you need to defend your independence?
Yes, without question, I do. I think when I talk to elected representatives in both political parties in the House and the Senate, and I think there's very strong support on both sides of the aisle, on both sides of Capitol Hill, for an independent Fed. I think people do understand that we're just there to do our job on a non-political, non-partisan basis. Nobody's perfect. Everyone makes mistakes, but the Fed is doing the absolute best we can with the tools that we have and the understanding of the economy that we have. I think that is very broadly understood and supported on Capitol Hill. So I'm less worried about that than the sort of things that have been in the press lately might suggest.
Same question. Do you feel as though the ECB's independence is well enough enshrined?
Oh yes, I think the ECB has one of the strongest statutory independencies of maybe all central banks in the world. And I just, let's zoom out just for one moment. I mean, this inflation shock that we had, if you compare it to the previous inflation shock of the same magnitude, which was the 1970s, when we didn't have independent central banks, the main difference why I think now we have a credible prospect of getting the problem under control within, let's say, 3 or 4 years, while in the 1970s it took 10, 12 years, and the disinflation was so much more painful. The sacrifice ratios were so much higher, higher unemployment, etc. The big difference is central bank credibility. During this huge inflation wave, inflation expectations continued to be well anchored. They never drifted away from 2%. This is so different to the 1970s. And why were inflation expectations so much better anchored this time around? Of course, that you can have a debate about it. It's about psychology, etc. But I would posit that the higher degree of central bank independence is clearly an integral part of that story. So this is a very tangible way in which we can show to society the benefits of having independent monetary policy making.
Would there be anything that you'd like to add to that on the case for central bank independence?
I think Klaus said it very well. I mean,
Boring.
In the United States, we don't have the quite the constitutional, I think, support that you have for it. It's a statutory arrangement. It's an institutional arrangement that has benefited the public.
Okay, I'm a little pissed. I only needed to make $80 more, and I would have been at a $69,000 trade. Holy crap. Thank you, JPow, for pumping the calls. We just sent that alert in the Stocks and Psych group like 15 minutes ago or whatever. So thank you for being a dove today. I might re-enter those positions because that was ridiculous. Just a heads up what was played. Look at this. Literally played line to line, baby.
We got an opportunity, boss. Some hot product just
like
came up. More expensive than a normal shipment,
Boom,
but more
just
profit
printed.
potential too.
You
want to
There's
go
the
for it?
P&L
Come
for
back to
today.
the office soon to make the deal.
758, 68K, and legit line to line. That's it. Those are the alerts I like to say. It's not 69,000, so I'm a little pissed off at myself, okay? I should have been $69,000, but it wasn't. Anyway, so just saying, let's go back to Pal. If you want to remember, there's a coupon code expiring. You get lifetime access to those sorts of alerts in the Stocks and Psych group if you join those at meetkevin.com. Oh, they're over.
Good. No, please sit, because we just take a seat for a minute, because we would like to thank you officially also from the whole board, from the Foreign Bankers Association, who has asked me and given me the honor to say some closing remarks after this really impressive session.
I'm going to go through a summary of everything JPow just said, so we'll do that. And then just in transparency, I want to show you the minute the alert went through. The alert went through, I could show you because some people are wondering. The alert went through at 7:48, which is 10:48. So it's right there on the candlestick, right there. That's where my buy alert went through right there. And it's still holding on to this line, by the way. So, you know, you could probably get out a couple sticks more profitably than me. Now, I don't trade for you, right? I can't guarantee that you buy or sell or whatever, and you got to have desktop notifications on and stuff. But I thought this Powell meeting was pretty bullish, and I thought there'd be a little bit of a rally there. And I think that's what we're getting in the queues as well. I don't know. So if we get some dips here, I might want to re-enter and play some trades again. Like I'm also watching Enphase is another one I'm watching. Because look at that, folks. It's a perfect move on the 113. Like I just find when I play the lines, I make money. It's that simple. I play the lines, I make money. So simple. Let's go, baby, in that trade, up 50%. Let's go. That's freaking awesome. Good job. Congratulations. So, I mean, that's just what I find. So, but yeah, in transparency, that alert went through at 7:48, and I can actually show that to everyone, so you know it's not bullshit. You just saw the chart, and my goal is, like, if I make money or lose money, I just want to be transparent about it. I've shown my losses too. This is the top of the alert. I don't want to put it all up there, but you can see 7:48 going calls for this JPow, post JPow speaking. And then I go into some more of a description in terms of why and blah, 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 and what I think is going to happen and so on and so forth. And then also where I think the stock is going to, which is what we played there on Tesla, which again, just turned into this on the P&L. This is the realized P&L. Realized P&L. Let's go. There, I'll hide that. You can see that it was two trades. It was Tesla and Spirit. Anyway, all right. Let's do a summary here of JPow. So yeah, anyway, if you have questions, just email us at staff@meetkevin.com. We'll take care of you. And coupon expires tomorrow for the Stocks and Psych group. So, okay, are we done with JPow? Who's speaking now? I mean, JPow's still sitting there, so I don't...
Behind the FBA, and already for many years, Alet Kudam. Without you and your immense support to support the FBA, its members, and the FBA board, and the wider community, we would never have been able, and certainly not being able, to hold these great events as we have here today. May I get an applause, please?
Let me see if there are closing statements here. Like, if JPOW gives any closing statement, it's important.
Please allow me to also extend a thank you to everybody who has been supporting and organizing this event, including Team DMB, Cognito, and also all the staff present here today. Additionally, we would like to thank all our business partners who throughout the years dedicate their time and resources to provide...
And again, what I'll do is, once we have the all clear here, I'm just going to go through a full summary along with my distillation of what JPOW just said. It actually has pretty big implications for tomorrow as well. So, you know, we'll listen in, because I think we got some hints here.
It's going to be huge.
All right.
Why would an operation like this be involved if it wasn't going to be huge? That's the level we
FBA
operate
and the
at.
events we organize.
Boss.
So again,
What do you
thank
need?
you very much, and have a nice evening.
Hello.
Anything? Anything? Closing statements? That it? That's it? It's gonna be it? Bro, come on, man. Look at that. Look at that. You can't make these lines up. I don't understand it. I just know the line to the line, I make money. I fight the line, I lose money. That's it. That's just what I've learned. So when I send the alerts, if I play the lines, I personally find there's a higher chance of making money. Obviously, I'm a little happy today because I'm a little pissed I didn't make an exact 69. I wanted that 69, but you know, we'll take it. All right, let's go do summary here, and this has implications for tomorrow. So let's get started here. One sec. Okay, all right. So to do this, let's see here. How am I going to do this? Okay, we're going to put this right here. Up. Okay. Sorry, it's just going to take another second here. Let's push that button. And then this button.
The clearance codes are up to date. End of discussion.
Okay. All right. Draw the lines higher, please. That's a good one. I like that. Okay. All right. So let's push this button over here. All right. Summary time. Got to fix the hair a little bit. Got a SpongeBob mug ready. Wow, just this morning we got producer price numbers, and JPOW had a big message for us, and I think he gave us a hint as to what we should be expecting for tomorrow. This is a pretty big deal, so let's get into exactly what happened this morning, what Jerome Powell just said, what to expect going forward, and how this could affect your trading and potentially...
I've got some movie memorabilia for you. Old reels of a Richard's majestic picture that were never meant to see the light of day. I'd warehouse them quick, or they'll end up on Bleeder.
This morning, I sent out an alert at 7:48 a.m., which puts you right here on that... oops, let's go ahead and... there we go. Puts you right there on the Tesla chart. And we played calls all the way up to that 178 line. When we sent that alert out, we were able to pick up almost $69,000 on that Tesla and that Spirit trade. We do have an expiring coupon code on those trade alerts in the program of Building Your Wealth in the Stocks and Psychology of Money group coming out tomorrow at 11:59. That'll expire. We can send that alert just so you can see it. Now keep in mind, this is California time. We sent that alert right there at 7:48, which aligns, since my Weeble's on Eastern time, which aligns, and I gave a full description there, I'm just showing a little preview there, which aligns with my alert right there, 10:48 Eastern time, 7:48 in California time. So we played these lines pretty nicely, got out at about 178. Let's go! All right, so now for the summary. So, PPI this morning came in hotter than expected. JPOW was asked about it, and he indicated, hey, look, it was actually pretty mixed. The reason for that is some portions came in hot, and within that services section, a little hotter. 3/4 of the increase was due to services, and we got a little hotter than expected read in the April data. We had an over expectations month-over-month and core month-over-month read, but the downward revisions from last month were actually greater. So we beat by 0.2 on the month-over-month, but came down by 0.3 on the prior month. And then on the core month-over-month, we beat by 0.3, but came down by 0.3, which is sort of balancing this out. If anything, somewhat to the dovish side. Now, Jerome Powell, when asked about this, called this data mixed. Now, what's interesting about this is he's asked, hey, what part of inflation concerns you? And this I thought was very interesting. He said that really, you don't need all three of the buckets. Remember, goods, housing services, and non-housing services. He says we don't need all three of those to actually come back down to 2%. This is the first time he said this, and that's the moment that I went bullish. When he said this, I went bullish, because once again, he started washing his hands of higher inflation data, which that might be short-term medicine. Maybe he's just propping us up to let us down. In fact, I think my "this time is different" count, he said this time is different like 3 or 4 times during this time. We'll talk about that in a moment, but what he really did, so, maybe he's setting up false expectations here, right? But what he really did is say, the PPI data was mixed. We'll see what CPI comes in tomorrow, but we still expect some progress on inflation in the second half of the year. And we're going to need more than just 1 quarter of data to see what the trend of inflation is. So think about what he did there for a moment. He washed away the entire first quarter going, 1 quarter doesn't make a trend. Look at how dovish he's trying to be. He washed away the entire first quarter. This morning he's like, the revisions were good. It was pretty mixed. Not a big deal. We're going to need more data than that. And then when he's asked about, rates basically potentially going up, he suggests, very small probability. He does say, I don't want to give up on it yet. Now, I thought that was interesting because it does somewhat imply that there's a little bit of him that says he might have to flip on us and U-turn and go Paul Volcker. That's kind of why in my trade alert that I sent this morning, that almost $69,000 realized profit, right here, I wrote 80% bull, 20% hawk. The 20% hawk that I wrote on this post is because Jerome Powell he gave this hint that I haven't heard him give before. This, I don't want to give up on it yet. So he's really confident that inflation's going to come down. He just believes it's going to take longer. But I want to be clear, when he says that you don't need all three of those buckets to go down to 2%, to me, I thought that was really interesting. That was breaking with the tradition of what markets have thought, that you really want all of those buckets at 2%. He's really trying to say, hey, if we have, housing, non-housing services inflation running at, say, 3%, and goods inflation running at negative 1%, and housing services at 0, well, then we average to, let's say, 2%. The math might not be perfect there, but you get my point. The point is, if you can average out to 2%, then who cares if services are running a little hot? That was another way of washing this inflation data. And that's really weird. I don't know if it's sustainable. Now, keep in mind, obviously, we're in the middle of a meme rally. We've got, I've actually posted the short interest on ehack.com. Just go to ehack.com. I posted all the short interest for today that people have been interested in. SunPower at 95%. This doesn't cost any money. This is totally free, right? I like to be transparent. Yes, the courses on building your wealth with the expiring code tomorrow, those cost money, but you only pay for those once. Some people have been in those for 4 or 5 years now, and they get more value every single day. But anyway, SunPower 95% beyond, Meat 41%, EVgo 31, Plug 28, Run 24, Lucid 31, Virgin Galactic 30, Laser 30, Carvana 28, Spirit Airlines 27, Microvision 25, GameStop 23, Tupperware 23, Rivian 21, Fubu 21, AMC 19, SoFi 18, Tilray 14, Clove 13, and DJT 9.3% short of as a percentage of float over here. So you're going to see some of this data over here on ehack.com. You're welcome to scroll through this and see this. But you also see some of my notes from JPow. But let's keep going because I'm also adding more sort of opinion here in this video to add to the facts of what Jay Powell said, so that way you get some more contextualization. So I've personally been concerned about the labor market. The labor market's been a big source of concern for me. It's something that's made me nervous and uncertain, mostly because I'm seeing more people get laid off and then having trouble getting new jobs. We're seeing job openings roll over. Jerome Powell says we're back at 2019 levels of labor market tightness, which he says is good. He sort of cheers that we have 27 months of under 4% unemployment, which, in fairness, is really good data. He's absolutely right about that. He says we have a very strong labor market, rising spending, households are in good shape financially, we're not over-levered. He says consumer spending has held up, business spending has been strong, large immigration, they're consuming and working, boosting growth. The labor market is very, very strong, he says. A little typo there we go. Labor market is very, very strong. It's coming into better balance, though. And so he sees it sort of cooling, but he calls it a gradual cooling. Some of the things in the labor market that I've been seeing have personally made me a little more nervous, but maybe I'm being too bearish. And so I have to be real here. When I listen to Jay Powell, he definitely seems more bullish than maybe I have been. And so this is why I also like to, when I heard this bullishness, I'm like, I'm going to buy some calls. And I'm glad. 6.9%, I'm going to take it. I'm going to pick that up and put it in my pocket and go, thank you very much. But anyway, on inflation, higher than expected Q1. He does say he did not expect a smooth road, but inflation was higher than expected. And we'll have to let restrictive policy continue to do its work, basically. And so the big message here from Jay Powell is we can really expect to stay at these rates for longer, that we don't really need to hike. And even though inflation data has come in mixed on PPI, it's not something that's really concerning him at this point. Neither is the banking sector. Now, he did mention a few times this time is different, people locking in low-rate mortgages, and therefore this economy is maybe less exposed to some of the risks of being in a bubble, which he mentioned the word bubble as well. Part of that was due to the banking sector, and he said that the biggest problem in the banking sector is when you get a banking run. The Netherlands central banker was there as well. He talked about June being the tentative first rate cut and services inflation coming down finally, which, by the way, is good. Like, service inflation coming down in the Netherlands is good, because that probably does mean at some point in the long term we'll have global services disinflation, right? And that'll help us in the United States as well. But really, I think overall this was a very bullish shape-out and could have been a lot more hawkish. It's not a surprise to me that we kind of started seeing the market move up after that. And going into Jay Powell, we had nervousness, right? So opening statements, you get this rally. Oh no, Jay Powell's starting to talk about inflation. Market goes down. I entered my calls right here at 10:48 Eastern. I sent those alerts. At 10:48 is when I sent those alerts. And you can see here there are a few minutes of sort of sideways. But then as soon as that event started coming to an end, that's when you started really seeing a run. Now, how sustainable that is going to be into the rest of the day, I don't know. I just really wanted to trade Jay Powell talking. But it's possible we could also get a rally into the close. I don't think we're going to have a fall into the close. And you can see here off of that alert, there are plenty of opportunities here to close around 178. In fact, if you wanted to be perfect, I think I closed right about here as we were just hitting 178. That was my goal, run to 178. You could have actually held to about 179.50, almost 179.49 over here. But personally, I'm a big fan when it comes to trading that I go in with a strategy, I try to go line to line, and when I make a profit, I'm going to take a profit. I don't need to squeeze every single dollar out of a trade. The worst thing to have is the FOMO of oh, I should have sold there, I would have had more money, because that'll leave you in trades too long, and then you might diamond hand a losing trade for too long, and that's when you really get smoked in trading. So just some sort of free trade advice there. But anyway, these are my thoughts on Jay Powell. I have to say, maybe I need to reevaluate some of my my sort of bearishness. But let me be clear. I still see cracks in the labor market. I still see cracks with household debt. BNPL, I think, is sector, the non-bank sector that JPOW is, he's aware of. He mentioned it too. The non-bank sector doesn't have that regulation as much as what he said compared to the regular banking sector. So he's aware of these. I don't know. I have to also be careful that I'm not getting too bullish just because JPOW's bullish, but because he could flip very quickly. So I'm going to go into CPI tomorrow hedged. Now, the $69,000 basically we just made basically means all of my hedges could go to zero, and I think I'd still be up money, which is crazy, and I don't expect them to go to zero. But if we get a bullish or mixed CPI read tomorrow, mixed or better data is going to be bullish. The only way we really get bearish data tomorrow on CPI is if we end up getting... let's look at the expectations. We're looking at 0.4 on month-over-month, 0.3 on month-over-month core. You'd really need those to come in hot, and the revisions not to offset that. So you'd really have to be CPI month-over-month like 0.5, core 0.5, and the revisions coming in flat, basically no revisions. That's really the way I think you would get a bearish day tomorrow. And I don't think a lot of people are hedging going into tomorrow. So I still think there's an opportunity to pick up some cheap hedges today going into tomorrow, if you want to hedge your long portfolio. Hedges are a little different from a day trade though, right? Day trade, you're playing the lines. Hedging, you're really playing an event, and you're trying to protect yourself from some downside elsewhere in your portfolio in the event you had some kind of correction. So, for example, I'm way more long than I have my hedge, but my hedge is also leveraged through options. To where if my hedge pays off, it'll pay out substantially, probably more than the loss the overall portfolio would experience. So again, that's the nature of a hedge. So we'll see how the day goes. But CPI obviously tomorrow is going to be a big deal. There's a chance you get a rally into the close on the bullish JPOW we had today and the mixed PPI data, which I think is a little bit of a hint that we're going to get a pretty basic CPI report tomorrow. But it's also something to keep in mind that the markets tend to have some fear going into the close before CPI, mostly because of the fear of the unknown. So keep that at the back of your mind if you are thinking about going bullish on the day. Nvidia's obviously gone from negative to positive. You can see that here. I wouldn't, there is a risk that while you could run towards the close, like the last bit into the close, sometimes you see a sell-off right before CPI. So if you're getting tendies on a run, if they come quickly, I'm a big fan of taking them. If you can milk them throughout the day, great, take them. BTC is sending a somewhat bullish signal, given that we're trending above that 61.7 line. This 61.7 line, everybody should have this one drawn. 61.741. It's not so perfect right here on the 1 minute chart, but if you go out on the 30-minute, it's okay. You got a couple rejects over here, a few rejects over here. I just find we sort of magneto around that. That's just see kind of pause over here a little bit. You get a bounce over here a little bit. We've played this line many times before. 3 over here, 1 over here. And when we extend below it, we keep coming back to it. And when we extend above it, we keep coming back to it. So that's just been sort of a recent trend that I've seen. I drew it as yellow because it's not as perfect as if it were a blue. That's just sort of my trading strategy to differentiate the lines that I have. Yellow is like, this looks like something that's going on. Like one that I saw as well that we traded on. This was a rougher trade. I only made $800 on this trade. I was up like 5,000 or 6,000 at one point, and I kept holding it, and I got out at positive 800. But it was this trade line right here, 1794. When we rejected off of that line, I closed and then it dropped all the way down to like $16 or whatever. So this I think is becoming a more important line, though we'll see. We kind of touched it a little bit over here. So we'll see what happens with Robinhood. Clearly we're moving up a little higher now because of the momentum movement that we're getting over here at GME and AMC. GME line today that I'm watching personally for trades is right here. It's where we're sitting right now. Basically the 52.40-ish line right about there. I'm trying to break through on that now. So that's another one that I'm watching. So we'll see. I'll do one last check here on
Hello, sir. How can I be of help today?
Land, not ideal. Remember, I'm a big fan of playing the lines. An easy one today. I didn't play this one, but it would have been an easy one. Is when we extended above 19. I was
Certainly.
at it,
What's your destination?
I really don't like trading the first 15 minutes, so I did not trade on it. But I was watching it. I'm like, ooh, extending above 119.
Excellent. It's on its way.
Sure enough, pulls back, breaks the 119. Look at that. Right down to our 113 line and comes up. And you know that line's been there for like ever. 113.40 is the line. So I like playing the lines. And I don't know if we're going to have enough momentum to really push Tesla higher than this. It's possible, but I don't know that we're going to make it to 183 today before CPI. Now, if we get a bullish CPI, we'll push right up to 183 tomorrow. But I don't know that I want to bet on a bullish CPI, and that's why I'm going in a little hedged, especially with that PPI data we got this morning. If we don't get as generous of a revision, we might be a little screwed on CPI, but we'll see. J-Pal still, keep in mind, thinks that there's a good chance we're going to see a downward move in inflation in the second half of the year. So that's J-Pal's take, is the second half of the year ends up giving us the bullish inflation read. Now let me see what the suits are saying, if there's anything on J-Pal from what the suits are saying. Sometimes you could get something from Nick T. If you don't follow him yet on Twitter, I'm a big fan of him, X. He's a good guy. And we have any tweets from him 55 minutes ago. No meaningful change in the economic outlook since Powell's last comments. No meaningful change in the outlook today. Key line, we're just going to have to see where the inflation data fall out. So, Nick T, other takeaways, Powell maintains policy is tight by many measures. The policy rate is restrictive. The question is it sufficiently restrictive? And that's going to be a question that time will tell. But we do not expect this to be a smooth road. These are some of the similar summaries that we got. Balance of risk, no timetable for cuts. He used to, by the way, say, we'd like to cut this year. We didn't see that here. Now, if I go into the probability of rate cuts in December, we're sitting at about 1.75 right now. So we've been somewhat stable there, and tomorrow's CPI is really going to move us into one direction or another. So that's Nick T, a little bit from the suits as well, and broadly we got a little bit of that post Powell rally here as expected. How we go into the close, I think will be tenuous again until CPI. Keep in mind that CPI tomorrow is like the last big catalyst for a while. I mean, you got NVIDIA earnings coming up, and obviously those will be a big catalyst for AI. But I mean, I'll read off the catalyst to you. Quick reminder: the first catalyst after CPI and retail sales tomorrow, which CPI we've already gone through. Retail sales are expected to come in. Advance 0.4, X Auto 0.2, X Auto Gas 0.1. So low expectations on retail sales. We could beat that.
Okay, you all set?
Retail sales to come in negative.
Nothing like
CPI
transporting a batch of arms across the most violent state in the country to give you that serotonin.
Attendees on that one tomorrow, if that happens. Stagflation is not what you want after tomorrow. After tomorrow, so after CPI retail sales, the next catalyst will be the expiration of the coupon code, 11:59 p.m. tomorrow. Remember, while we J-Pow traded, pulled off this almost $69,000 profit. That's a realized P&L for today on two trades we placed, one on Spirit Airlines and one on Tesla. So if you want those trade alerts, make sure you're part of the Stocks and Psych group, and you'll get all of those trade alerts. No guarantees we can always print, but...
Hello, you're through to Pegasus Lifestyle Management. How can I help?
Killing it. So...
Thank you, sir. Your spectacular aircraft is now ready for you at our nearest airfield.
If you have questions at staff@meetkevin.com, but that expires tomorrow. Most people who email us, they just want to bundle up. They say like, hey, I already have a course. I want the real estate course, or I'm in the real estate course. I want the stocks one, whatever. We're going to get initial claims on Thursday. 220,000 is what we're expecting. Continuing claims, 1780 is the expectation. Those will be slightly softer than what we got last week, so we'll see. We'll also get housing starts expected to be up 7.5% month over month, so we'll see if we get that. That'll be tomorrow. We'll get import and export prices tomorrow, so we'll get a lot of price data tomorrow. All of that, by the way, sorry, that's Thursday morning. All of that over the next 2 days, all at 5:30 a.m. So if you haven't yet subscribed to the Meet Kevin Market Live channel, make sure you do that. Meet Kevin Market Live. You actually download the Meet Kevin app in the iPhone Apple Store and get notifications if you prefer to have that all in one place. And we're going to make sure that comes back up again on Android as well. Those green textures. You got to have green respect too. So those are the really the big catalysts coming up. After that, if I go into next week, I get, PMIs, University of Michigan consumer sentiment. That's all a little boring, honestly. None of those are like mega catalysts. Really, the next mega catalyst, frankly, it's NVIDIA. We'll get Walmart on Thursday, John Deere on Thursday. We'll get JD, but Baba missed. So, not great there for Chinese sales. Palo Alto Networks, Lowe's and Macy's next week. Toll Brothers, Target next week. NVIDIA and Snowflake, mark your calendar for May 22nd. That's a week from tomorrow, a week from the expiration of the calendar. That'll come out. We'll also get into it at the end of next week. And honestly, then we're kind of chill on catalysts. We don't have the next FOMC meeting until, I think it's the second week of June, June 12th. And then the next jobs report should be the first Friday of June, which is June 7th. June 7th, we'll get the first jobs. Actually, I think that's the second Friday, because the first Friday might end up on first. Let's see here. Nope, it is the first Friday. And first Friday, we'll get the jobs data. So honestly, after tomorrow, we're kind of just twiddling our thumbs until NVIDIA next Wednesday, and then jobs on the 7th, and JPOW on the 12th, and then of course we'll have CPI again, which you may as well write that one down. CPI release for June should be like June 12th as well. It is on Fed Day. You get the May inflation data on Fed Day. That's going to be a wild day, but that's all down the road. So anyway, yeah, that gives you an overview of everything that JPOW just said, my thoughts on the market, my thoughts on hedging. And again, if we can get non-stagflationary numbers tomorrow, maybe I'm being too bearish. Remember, I've been mega bull since like November of 2022. Nike swoosh volatile recovery, everything moon. Up until about the last 6 weeks. I try to be as transparent as possible on the channel. I love all of you who support me and always come back, so thank you for that. I'm not always right, I try to give you my opinions, and I'll tell you, every freaking turn, JPOW, late like this year, he just keeps trying to go for the bullishness. I don't know, I think he already knows what the CPI data is tomorrow, and I don't think he would have been as bullish today if the CPI would have been bad for tomorrow. So I'm like a little nervous that my hedges are just going to get burned tomorrow, but I'd also be really pissed if I closed my hedges and then we got a miss, because then I'm going unprotected in tomorrow. And remember, folks, always use protection. And get life insurance in as little as 5 minutes. Did you know they were a sponsor of the channel? I just finished this at the beginning of the video. I say that because sometimes people get mad at me in the comments. They're like, Kevin, it seems like your cup is empty. You're right. Right now it is empty. But anyway, make sure you get life insurance in as little as 5 minutes by going to metkevin.com/life, paid partner of the channel. Anyway, with that said, let's push a button here.
Go yourself. Is that clear?
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products or even paid affiliations or products or services which we may benefit from. I personally operate and actively manage the ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than House Act, nor am I personally acting as a market maker. Look at that VWAP move. Look at that. Double reject on the VWAP for end phase, playing the VWAP. Wow. That's definitely algorithmic. Anyway, thanks, folks. We'll see y'all in the next one. What if you want a quickie Raptor sticky? Oh, no, I've never heard of that before. I can't unsee that. I gotta go.
lightheaded as hell.
Anything you want, please let me know.
나온다고? You're looking good.
Listen to me.
Here for the magic touch? circle did you want me to perform? They won't shoot these out. brings you in today?
I'm on the clock. What you want? Some wheels? I'll bring it to you.
We went to Del Perro Beach and Chumash, yes?